In this video, we are going to discuss the concept of cost of capital. We are going to discuss what is cost of capital and why cost of capital is important. So first, let's understand what do we mean by the term capital. Capital is nothing but the money that is invested in the business. And we know that there are different sources of capital. So the capital can be raised in the form of equity, debt, or preference shares. And there is also an internally available source of funds, which is nothing but the retained earnings of the company. The retained earnings is nothing but the profit which is not paid out as dividend. So retained earnings. So these are the different sources of capital, and none of these sources of capital will come for free. There is a cost associated with each and every source of capital. If the company is raising finance in the form of equity, the company has to pay what to the equity shareholders? The company has to pay equity dividend. So equity is a form of capital, and there is a cost associated with that form of capital, which is nothing but equity dividend. If an organization is raising finance in the form of debt, the organization has to pay interest to the debt holders or debenture holders or bond holders. So debt is a form of capital, and there is a cost associated with that form of capital, which is nothing but interest. So similarly, for preference shares, the company has to pay preference dividend to the preference shareholders. And for retained earnings is an internally generated source of funds. So there is an argument that since it is an internally generated source of funds, there is no cost associated with retained earnings. But this argument is wrong. Why? Because, for example, let's say EPS of the organization is EPS is nothing but earnings per share. Earnings per share of the organization is, let's say, rupees 100 per share. And out of this 100 rupees, let's say the company paid out 30% as dividend. So 30% is nothing but dividend payout. So out of 100 rupees, 30 rupees is paid out as dividend, and remaining 70 rupees or remaining 70 percentage. A remaining 70 percentage is retained by the company for future growth. So out of 100 rupees, 30 rupees the company paid out as dividend, and remaining 70 rupees is retained by the company. So this 30 rupees belongs to the equity shareholders, right? The company has paid out 30 rupees. So this 30 rupees is in the hands of the equity shareholders. This 70 rupees is in the hands of the company, but the 70 rupee belongs to whom? The 70 rupee belongs to the equity shareholders, but it is in the hands of the company. To put it very simple, the 70 rupees is the equity shareholders' money, which is in the hands of the company. Right. So now the out of this 100 rupees, the company retained the 70 rupees. Now let's say instead of retaining this 70 rupees, if the company had paid out the 70 rupees as dividend to the equity shareholders, what the shareholders would have done? The equity shareholders would have invested this 70 rupees elsewhere, and from that investment, they could have earned some return. Now, because the company retained this 70 rupees, the equity shareholders cannot earn that return. So they are foregoing an opportunity to earn return. So that becomes their opportunity cost. And that opportunity cost is the cost of retained earnings. I hope it is clear. So here we can see that there are different sources of capital, and for each source of capital, there is a cost associated with it, right? So the cost associated with equity is known as cost of equity, and the cost associated with debt, which is interest, is known as cost of debt, and cost associated with preference share is known as cost of preference shares, and cost associated with retained earnings is known as cost of retained earnings. So cost of equity is represented by the symbol KE, cost of debt is represented by KD, cost of preference share is represented by KP, and cost of retained earnings is represented by KR. Now let's take a simple numerical example to understand what is cost of capital actually. Let's say the fund requirement of the organization is 300 million. The organization requires, oh wait, let me write it. So let's say the fund requirement of the organization is, let's say, rupees 300 million. So the organization has to raise finance worth of 300 million. Now, out of this 300 million, let's say, out of this 300 million, let's say 100 million is coming in the form of equity, and another 100 million is coming in the form of, let's say, debentures, and one more 100 million is raised in the form of a, let's say, secured bank loan. So the total fund is 300 million rupees. So here, for the sake of simplicity, we have ignored preference shares. So there are only two major sources of finance. One is equity and the other is debt. So here, both debenture and bank loan is a form of debt, and equity is the equity share capital, right? Now, so there are three types of investors. There are two types of investors in this company. One is equity shareholders, and the other one is lenders of the money. So the debentures and the bank loan they are the lenders of the money, and equity shareholders are the owners of the company. Now, out of these three types of investors, who's going to take more risk? Obviously, the risk taken by the equity shareholders will be high. Why? Because the organization will pay dividend to the equity shareholders only if they are making sufficient profit, right? It is not a statutory or a legal obligation to pay dividend to the equity shareholders. So it is completely at the discretion of the company. So the return earned by the equity shareholders is fluctuating. In 1 year they will get more dividend, and the next year they might get less dividend or even no dividend, right? So equity shareholders return is fluctuating, so equity shareholders are taking more risk. So if they are taking more risk, obviously they will expect more return. So for example, let's say the return expected by the equity shareholders is 25 million. Now, if equity shareholders are expecting 25% return, who has to pay that 25% return? The company has to pay it. So shareholders' expectation becomes the cost for the company. So I'm writing this column as cost. So the return expected by the equity shareholders is, let's say, 25 million. And the debenture holders are expecting, let's say, 15% return, because the debenture holders are relatively taking a lesser risk than the equity shareholders. The reason is very simple. Whether the company is earning profit or incurring losses doesn't matter. The debenture holders, they are going to get a constant amount of interest, right? So the return earned by the debenture holders is not fluctuating. It is remaining constant. So the debenture holders are taking less risk. So they are expecting, so their expectation is also less. They are expecting only 15%. Now let's say the bank is expecting 10% return or 10% interest. So the return expected by the bank is lesser than the return expected by the debenture holders, because it is a secured bank loan, which means if the company is not paying the interest on time, or if the company is making any default, the bank can confiscate the assets of the company. So the risk taken by the bank is even more lesser than the risk taken by the debenture holders. So the expectation of the bank is very less, only 10%. So now we have the cost in terms of percentage. Now let's put it in terms of rupees. So costs in terms of rupees. So equity shareholders invested 100 million, upon which they are expecting 25% return. So what is 25% of 100 million? We get rupees 25 million. So this is the expectation of the equity shareholders. Debenture holders invested 100 million, upon which they are expecting 15% return. So it is rupees 15 million. And bank, they gave us 100 million loan, upon which they are expecting 10% return. So it is 10% of 100, we get 100 million. Now, when we add 25 plus 15 plus 10, we get rupees 50 million, right? So listen, this 300 million is nothing but the capital raised by the firm. And this 50 million is nothing but cost incurred for raising this capital. So my capital is 300 million. So in order to raise 300 million rupees of capital, I have to incur a cost of 50 million rupees. So now let's calculate the cost in terms of percentage. So cost in percentage. So we raised a capital of 300 million, upon which our cost is 50 million. So it will come to 16.666 percentage. We can round it to 16.67 percentage. So this 16.67 percentage is nothing but cost of capital of the company. Now, how to interpret this number, or what does this number tell us? So that is what we are going to discuss. So now here the firm raised a capital of how many million? 300 million. So now what the firm will do with this 300 million? So here, let's say this is the balance sheet of the company. So the company raised 300 million capital, and this 300 million will be invested in the assets of the company, right? Now, this asset will be used to generate what? By making use of these assets, you will produce the product and you will sell it in the market and you will earn profit. So basically, this 300 million worth of asset, and let me write it, this is capital. Okay. So this 300 million rupees worth of asset will be used to generate return. For example, let's say the company is planning to generate a return on asset is equal to 20%, which is nothing but they have an asset base of 300 million, upon which by making use of this 300 million worth of assets, they are planning to generate a return of 20%. So on this 300 million, they want to earn a return of 20%. So what is the return on asset in terms of rupees? Return on asset is equal to, so they have an asset base of 300 million, upon which they are expecting to generate a return of 20%. So it will come to 20% of 300, we get 60 million rupees. Now, can the company enjoy this total 60 million rupees? No. The company has raised finance in the form of equity, debenture, and bank loan. So obviously, the company has the obligation to pay back these investors. So first, to whom the company will pay? Whether the equity shareholders or debenture holders or the bank. Obviously, first the company will pay the money to the bank, because if the company is not paying the bank on time, the bank might confiscate the assets of the company. So first the company will pay to the bank. So what is the expectation of the bank? They gave us 100 million, upon which they are expecting 10% return, which is nothing but upon 100 rupees, if we take 10%, it comes to 10 million. So out of the 60 million rupees, 10 million rupees will go to the bank, right? Then second, the company has paid the bank loan. Then next to the bank loan, the company will pay money to the debenture holders. So what is the expectation of the debenture holders? They gave us 100 million, upon which they are expecting 15% return. So the company has to pay 15 million to the debenture holders. So out of the 60 million rupees, 15 million rupees will be paid to the debenture holders. Then finally, the company will pay to the equity shareholders. So this is bank and this is the debenture. Then finally, the company will pay money to the equity shareholders. So what is the expectation of the equity shareholders? Again, they gave us 100 million, upon which they are expecting 25% return. So their expectation is 25 million. So out of 60 million, 25 million will go to equity shareholders. So here, initially we had 60 million, out of which 10 million is gone for the bank. So we are left with 50 million. Out of that 50 million, 15 million will go to the debenture holders. So we had 50 million. Out of that, we took 15 million and we gave it to the debenture holders. So we are left with 35 million. Out of that 35 million, 25 million we will pay to the equity shareholders. Now we are left with how many? We had 35. We paid 25 to the equity shareholders. So we are left with 10 million, which is nothing but the surplus of rupees 10 million. So this is nothing but, let me write it as case 1, where the return on asset is equal to 20%. So what is important to understand is, what is the cost of capital of the company? It is 16.67%. What is the return generated by the company by making use of the asset? It is 20%. So here, let me write the conclusion. If return on asset is greater than the cost of capital, the company will have surplus funds. Now let's take case 2. Case 2, where return on asset is equal to, let's say, 15%. So the company has an asset base of 300 million, upon which they are expecting to generate a return which is equal to 15%. So what will be the return generated by the company? Is equal to, they have an asset base of 300 million, upon which they want to generate a return of 15%. So 300 into 15%, we get 45 million. So again, repeating the same process, the company generated a return of 45 million, out of which first they will pay to the bank loan. What is the expectation of the bank loan? I mean, what is the expectation of the bank? It is rupees 10 million. Then after paying the bank loan, the company is left with how many rupees? They had 45 million. They paid 10 million to the bank. So they are left with 35 million. Out of that 35 million, secondly, the company will pay to the debenture holders. So what is the expectation of the debenture holders? It is 25 million. Sorry, it is 15 million. So initially we had 45, we paid 10 million to the bank loan. So we are left with 35 million, out of which 15 million is paid to the debenture holders. Now, out of 45, 10 is paid. So we are left with 35. Out of 35, 15 is paid. So we are left with how many million? 20 million in hand. Now we have to, at last, we have to pay the equity shareholders. We are left with how many million in hand? We are left with only rupees 20 million in hand. But what is the expectation of the equity shareholders? Equity shareholders are expecting 25 million rupees in return, but the company has only 20 million. So the company will pay only 20 million rupees to the equity shareholders, and there is a deficit of how many rupees? There is a deficit of rupees 5 million. Why? Because the logic is very simple. The cost of capital of the company is 16.67%, but the return on asset is only 15%. So the conclusion is, if return on asset is less than cost of capital, the company won't be able to meet the expectation of the shareholders. So there will be a deficit. Right. So if return on asset is greater than cost of capital, there will be a surplus amount of funds available with the company. If return on asset is less than cost of capital, the company won't be able to meet the expectation of the shareholders. So what will happen? Here, equity shareholders are expecting 25 million, but the company is paying only 20 million to the equity shareholders. Right. So equity shareholders will be disappointed and they will start selling the shares of the company in the market. So what will happen? The supply of the share in the stock market will be more, because many people want to sell it. Many equity shareholders want to sell it because their expectation is not met, right? So the supply of the share in the market is more, but the demand for the share in the market will be less. Why? Because the company is not meeting the expectation of the shareholders. So many people will be reluctant to buy the shares of the company. So the supply is more, demand is less. Supply of the share in the market is more, demand for the share in the market is less. So eventually, market price of the share will also come down, right? So if return on asset is greater than cost of capital, the company won't be able to meet the expectation of the investors. Now, let's take a case 3, where return on asset is exactly equal to the cost of capital. So here, what is the cost of capital? It is 16.67%. So the company is also planning to generate a return equal to 16.67% on the assets of the company. So what will be the return generated by the company? The asset base of the company is rupees 300 million, on which the company is planning to generate a return of 16.67%. So when you take 16.67% of 300 million, it comes to rupees 50 million, right? So 50 million is the return generated by the company. So now, again, repeating the same process, out of 50 million, First, the company will pay to the bank loan, then the company will pay to the debenture, and finally the company will pay to the equity shareholders. So what is the expectation of the bank loan? Expectation of the bank loan is rupees 10 million. So out of 50 million, 10 million will be paid to the bank. Then out of 50 million, 10 million is paid. So we are left with 40 million. Out of that 40 million, the debenture holders are expecting 25 million. Sorry, debenture holders are expecting 15 million. So we had 40 million. Out of that, 15 million is paid for the debenture holders. So we are left with 25 million. What is the expectation of the equity shareholders? 25 million. So that 25 million will be paid to the equity shareholders. So what is important to understand is here expectation of all the investors is met. Bank loan expected 10 million, that is paid. Debenture holders expected 15 million, that is also paid. Equity shareholders expected 25 million, even that is also paid. So here, if return on asset is equal to cost of capital, then no surplus, no deficit. If return on asset is equal to cost of capital, the company will be able to meet the expectation of all the investors without having any surplus fund in its hand. Now, how to define cost of capital, or how do we interpret this number? Like we have a cost of capital of 16.67%. That is our cost of capital. How do we interpret this number? So cost of capital can be defined as the minimum rate of return that the company should generate to keep all the investors satisfied. So again, I'm repeating, cost of capital is nothing but the minimum rate of return that the company should generate to keep all the investors satisfied. So here you can see that case 3, where return on asset is exactly equal to the cost of capital, right? So what is the return on asset? 16.67%. What is the cost of capital of the company? Same 16.67%. So if the company is generating a return equal to its cost of capital, then the company will be able to meet the expectation of all the investors. Suppose if return on asset is greater than cost of capital, in that case, the company will have some surplus funds even after paying money to all the investors. But if return on asset is less than cost of capital, the company won't be able to meet the expectation of the investors. Clear? So cost of capital is nothing but the minimum rate of return that the company should generate to keep all the investors satisfied. If the company is generating a return at least equal to 16.67%, they can satisfy their investors. And if they are generating a return greater than its cost of capital, the company will have surplus funds. No. Why cost of capital is important? Why cost of capital? First, let me tell you the reason. Cost of capital is important to set right target for the company. To set right target for the company. To what? I mean, we have to set right target, but for what? It is to set right target for the company to determine the return on asset, right? So for example, let's say you are going to write an exam. The actual passing mark of that exam is, let's say, 50 marks. But you are not aware of the fact that you have to score 50 marks to pass the exam, which means you are not aware of the fact that the passing score is 50 marks, right? You're going to the exam, you are looking at the question paper, you are writing the exam only for 45 marks. After writing the exam for 45 marks, you are coming to a conclusion that, okay, I wrote it for 45 marks. At least I will get 40 marks and 35 is the pass mark, so I will pass. So you came out of the exam. And when the results came, it was a shock. Why? Because you failed the exam. Why you failed? Because the passing mark was 50, but you wrote the answers only for 45 marks, right? So here you failed the exam because you did not set right target for you. Why you did not set right target for you? Because you don't know the passing mark, right? Passing mark was 50. You are not aware of that. And you thought 35 is the passing mark. You wrote the exam for 45 marks and you came and you failed the exam, right? So from an organization's perspective, cost of capital is nothing but that passing mark. The organization should generate a return at least equal to its cost of capital to keep all the investors satisfied. So cost of capital is nothing but the passing mark, right? For example, let's say the organization is not aware of its cost of capital. So here we calculated the cost of capital is 16.67%. Let's say the organization is not aware of the fact that its cost of capital is 16.67%. Now, what will happen? Let's say the cost of capital of the company is 16.67, but the company is not aware of it, and they are uh, planning to generate a return equal to, let's say, 15%. In that case, what happened? Their cost of capital is 16.67, but they are not aware of it. So they set target for 15%, and they ended up with a deficit of 5 million. Expectation of the equity shareholders was not met. Right now, let's say the cost of capital of the company is 16.67%, and the company is aware of the fact that its cost of capital is 16.67%. In that case, what will happen? The company knows that, okay, my cost of capital is 16.67%. So I should generate a return that is at least equal to 16.67% so that I can meet the expectation of all the investors. And if I'm generating greater than 16.67%, I can meet the expectation of all the investors. And along with that, I will also have some surplus fund in my hand. I hope it is clear. So cost of capital, first we discussed what is cost of capital, the minimum rate of return that the company should generate to keep all the investors satisfied. Second, we discussed why cost of capital is important. Cost of capital is important to set a right target for the company to determine the return that they need to generate.